And I didn't prep you guys for Queen's
You
Court
didn't.
to
No,
pre-production.
you did
You
it. You
didn't.
usually tell us something and then we think
We
about it.
Exactly.
usually get a
Because,
hint.
well, I'll give you the hint. Give me the ETF, SPY.
SBY?
SPY. No, just give me
SB.
the
Oh, the
S&P.
spice.
Yeah,
Yeah,
S&P,
spice.
SPYs.
Yeah.
That's what I'm waiting for. We talked about this earlier. Actually, you can also give me the index ES, but we talked about, and there was a reason why I asked you that question specifically when we started the halftime report is what is one to do and how is one to approach, these next few days of CPI numbers and bank earnings and all that stuff. So for me, I've I feel like I'm there. I feel like I have what I need in terms of cash flow, in terms of everything I've got going on. I've cleaned up my weeds. I've taken out what I don't need. And when it comes to earnings season, I'm looking and I'm going, okay, I don't necessarily want to play the individual companies, especially the banks, until we figure out what's going on in that area. I'm intrigued with energy, right? I'm intrigued with healthcare. And so my question for you, if somebody was to go approach, okay, I can either play the overall market and play the spiders when we get that breakout, or I can go individual sectors and find plays there. Which would you rather? In an environment like this, where we're waiting for the breakout in the overall market, but you've got some sectors that are starting to look really pretty as well.
So is the question basically right now, are we looking index or sector?
Yeah.
Um, that's a good question because oftentimes the answer will be index. If it right,
Oh,
Mm-hmm.
but
absolutely.
right now, like in 2017, for example, when you had the Trump tax cut year and the market was up, what was it up? I think in 17,
A lot.
26, 28%, something like that.
Yeah.
That was an index year, right? That was a really good index year, right? When you go back to the quantitative easing, infinity driven market of 2013, that great index year, right? So that it is an appropriate question in index versus sectors because for about 15 years, Wall Street was pushing indexing for like all you needed to do is buy the S&P 500, right?
Mm-hmm.
That's it. In fact, Emily, you've seen me give many, many speeches many, many times
Yep.
teaching people how to simply buy the S&P 500 to diversify from their 401k mutual funds and all you got to do. And how many times have I said this? It's the easiest thing in the world. All you got to do is buy spiders.
Yep.
And then you get all your diversification that you were sold on in mutual funds without the fee structure of a
Yep.
mutual fund by
Yep.
indexing. And so it's a very important question. And indexing has been an extremely popular way and successful way of structuring a longer term portfolio where somebody maybe don't have the time to do everything that an active investor does or an active trader does. They live a busy life, have a family life, have societal, life. They have community responsibility. We're all pulled in a lot of different ways. Indexing can be a very, very powerful way to have control over your retirement account and your long-term portfolio without paying Wall Street and a ridiculous amount of money over time to do literally absolutely, and I mean this, Wall Street absolutely nothing, like legitimately absolutely nothing. And so indexing is a really, really, really great way to get diversification within a long-term portfolio without the fee structure and keep all your money. And so I don't want to throw in, and that's my way of not throwing cold water on indexing when my answer is sectors right now. And
Mm-hmm.
it has been that for the last year and a half. Remember when the market's in their bullish moments of in from a market cycle perspective, long term perspective, yeah, if an index is up 20%, one sector might be up 25%, the other sector might be up 18%, another sector might be up 12%. There's certainly separation there, but there's not separation there like there is in these conversations that become fundamental driven. Remember, those conversations are economic driven, they're long-term driven. The bullish market feeds all bullish trades. But in terms of these types of conversations in this type of economic environment where we're dealing with some legitimately concerning economic data, right? From an economic contraction perspective, these are serious, serious conversations when we're talking about inflation and think about the podcast conversations we're having the last 2 weeks on the reserve currency and what is happening with the reserve currency. These are extremely serious conversations. And then you think about what's happening with the banking crisis and how how banks are going to pull the lending from everybody. They're going to pull the lending from corporations. They're going to pull the lending from individuals. You know that's going to occur, and you know the credit crunch is happening. And so it's not it's not the environment where everything rises. It's not that environment where you can expect the index based on whatever economic reading you have or whatever inflationary read you have or whatever monetary environment you're dealing with. It's not that environment for the index to really, shine in this environment, because for the index to shine in this environment, you got to have that everything rocking, right? You got to have 80% of the market's bullish. That's not what this market is. The market might be short-term bullish right now, but it's on the backs of 60% of the market and 40% are doing absolutely nothing or down. You've had clear separation from a stock picker's perspective, because in these environments, when it's not a free money parade like the Fed created for 10 consecutive years, where you could fund any of your bad decisions with good debt from the Fed, it's not that environment. The haves and the have-nots will separate in this. There's a reason you're seeing tech outperform, but it's only on the backs of like 3 stocks. It's because of the Apples and the Microsofts. And what's the argument for that? The safety of them. What's happening with the staples in healthcare and utilities right now? You're seeing separation. And why? Because the safety of them. Why do we hate commercial real estate and XLRE right now? Because we see down the road, there's a lot of landmines in that area of the market. And so this market has clearly separated itself from the indexing philosophy into more of a stock picker's philosophy, which will always be sector dependent. So I would answer that question by, and again, I didn't want to throw cold water on the indexing because it's not something I disagree with. It's just something that I just don't feel fits the moment, right? Because in these moments is where you see the haves stand out from the have-nots that have been carried for the last 12 consecutive years. And so I do think it's a stock picker's market. I think it's going to continue to be a stock picker's market. And I do think indexing will be okay when you think about it long term. But over the next few years, I do think indexing will outperform stock pickers.
Coach Mark, what do you want to
Index will underperform stock pickers. Did I say outperform? Underperform is what I meant.
I knew what you were saying.
Yeah.
Yeah, I mean, I agree with Matt 100%. Maybe, for all of the reasons he said, and then plus me personally, I'm a thematic guy. Like, I'm going to go where themes is. Recession is the theme. The recession theme's not going away. As a result, I'm going to be looking for setups in utilities and healthcare and that, because I expect them to overperform, right? I expect them to overperform based on that theme. So, like, I'm going to go where the theme. There's going to be other times where the theme is like, boom, right? Like, let's go growth, right? So, and I think there is, like, on pullbacks, I think mega cap tech's going to overperform, right? Because of that, recessionary theme, flight to safety, all of that. So I 100% agree for all the reasons, plus my own thematic reasons. I just think you can have better results, through whether technicals, whether thematic, whether reading the room, whether just listening to the halftime report and being like, oh, these guys are really good at sector rotation, right? I just think
It's in our
you know,
wheelhouse.
Oh, you mean that thing that we do every Friday?
well, heck, we do it every day
Oh, we
these
do it
days.
every day. Yeah.
You know, so I mean, that's what we're really good at. I just think you just like want to be flexible in where you're moving the money. So I'm a big pick the sector over the index kind of guy.
Yeah.
Awesome,
Well,
awesome.
and just think about what Mark was talking about here, the emergence of a theme, the recessionary conversation and what happens with that. Well, typically, the aggressive side comes down a little bit, but what we also see is the defensive side solidifies itself a little bit more. And utilities looking pretty good here at the top, not underneath. We don't care underneath here. We're not looking to gobble up a 9 EMA bounce on utilities, but look at that 70 handle getting dialed in at on utilities. Looking at a little bit of a breakout there. Healthcare here doesn't want to stop. Doesn't. Like, can't you give us 2 more days of consolidation? Give us that secondary trigger, but it doesn't want to stop. That's a theme that is currently in motion right now. When you look at consumer staples, another high base, another breakout, caught the 9. This is what healthcare caught up to staples. Now you got to kind of match them doing the same thing. This looks beautiful on staples right here. Great breakout on staples. And so why did this conversation emerge with the defensive, and why was tackle trading in our halftime report at the forefront of these defensive movements? Because I didn't hear anybody talking about what was happening in staples before we were talking about Walmart. I didn't hear anybody in the financial media talking about healthcare before Coach Mark was talking about healthcare opportunity. And so why were they doing that? Well, we were looking at these potential breakouts. This is a secondary one. Looks good again. And so Mark and myself are both top-down analysts. That's how we approach the market. There are going to be times when indexing for mom and pop America is perfectly fine.
Warren Buffett said it best, right? Like, if you don't know nothing, just buy the SPY.
Right? Yeah, like indexing for mom and pop America, there's nothing wrong with that. I do not want to throw cold water on that in any capacity. But from an active perspective, if you are active in any capacity, top-down approach to the market with a thematic edge on sector rotation, I do think that's the winning philosophy against indexing.